A recent Investopedia study showed that around 83% of traders lose money. And if you spend much time with a few of those traders, you're likely going to discover one of their biggest problems is not being able to accurately forecast the direction a stock is going to move. Imagine for just a moment if you had some superhuman capability to know exactly what tomorrow's price of Apple was going to be. You'd create endless opportunities for yourself. It would almost be an unfair advantage. Spoiler alert. You don't have that superhuman, perfect market forecasting gene. Nobody does. But here's the good news. With some simple skills and practice, you should be able to get your forecasting right the vast majority of the time. The formula is simple. Better forecasting means more winning trades. More winning trades means more cash in your jeans. But how exactly are you supposed to get these superhuman marketing predicting skills? In this video, I'm going to show you exactly how to analyze the market and break down a couple popular schools of thought on that topic. First, we have to understand why the stock market is predictable. Short answer, because people are predictable. Let me show you what I mean. Imagine you come visit us here in Nashville, Tennessee, and as you're walking down Broadway, you see me off in the distance heading towards you, and you think, there's that nice guy from Tradesmart University. I think I'll go meet him and shake his hand. And as you approach me and extend your hand to shake mine, instead of shaking your hand, I actually slap it away from me. Keep walking on past. You might think, kind of imagine he'd be a little bit nicer than that. But what can you say? Maybe he's having a bad day. The second day, the same thing happens. We're walking down the street. You're heading towards me. We get to the same place at the same time of day. You stick your hand out to shake my hand, but instead of shaking your hand, pow, I slap it away. This is getting weird. Third day, same thing happens. You're walking down the street, heading towards me. You see me off in the distance. What are you going to do on that third day? Most people, if you're normal, are going to walk on the other side of the street and avoid me. You see, the first time you weren't expecting me to slap your hand away. The second time, that's just getting weird. By the time it happens the third time in a row, it's time to do something a little bit differently. Crazy as it sounds, that's about how the stock market works. Let me show you. Here's a chart of AFLAC, and you can see we've highlighted it in red here, an area where a slap on the street has been known to happen, around $58 on AFLAC. And as we're walking down the street, we get to that same price, that same place, pow, a slap happens. Everybody who owned AFLAC at $58 is suddenly regretting life's choices. We continue on a little bit. We're heading down the street. We get to that same price, that same place, and what do you think happens? Go ahead. In your mind's eye, what do you think happens? If you said, I think it's going to go back down again, you're right, and you're already starting to forecast the market. Now we continue on a little further. We're walking down the street again. We get to that same price, that same place. What do you think happens? This time, type it in the comments what you think is going to happen. Now, the big question is, how do we know where the stock market slaps are going to occur? To answer this, we've got to dive into two schools of thought. The first school of thought comes from a man named Benjamin Graham, the father of what's called value investing. It's a strategy that Warren Buffett turned into a fortune. Graham lived in the early 1900s, an era where the market was beginning to gain mass public appeal. People were high on optimism and low on logic. Spoiler alert, everything crashed. As traders were guessing, gambling, and reacting to trades based on emotion, Graham decided to change this. He created a framework of market forecasting that determined how much a stock is worth based on a company's financial data like earnings, expenses, assets, debts, and so on. We call this fundamental analysis. Think about fundamental analysis in the context of buying a home. You don't just buy one based on looks alone. You check the foundation, the roof. You probably hire a guy to come and find every possible thing that's going to need fixed. And then you compare it to other homes in the area and formulate a fair market price. Graham believes stocks should be treated the same way. Great idea, right? Maybe. The problem is, if this was exactly true, the price of a stock would only change after the company releases quarterly financial information. Take a look at this chart of Apple. On the bottom of the screen, you can see marked with an E every place that an earnings report is released. So if our friend Ben is correct, then we should get some information about Apple and a new fair market price is established. But notice, theoretically, it wouldn't move until new information comes out. And we get new information about Apple, price changes, people add or subtract stocks from their portfolio, and we move on. And we wait until new earnings information is released. and so on and so forth. But this doesn't look like any stock chart any of us have seen. Of course not. The stock moves every single second, not every single quarter. Now, I'm not saying there's not value in fundamental analysis. It's still used by many well-respected investors. However, it does force you into a much slower, long-term move unless it's paired with another system. Traders who want to predict shorter-term price movements must use another method. That leads us to Charlie Dow, who was born 48 years before Benjamin Graham. Charles Dow started with a different premise. He believed that the market could be predicted because people could be predicted. It's the foundation of what we now call technical analysis. Dow believed that every move on the chart is a result of a person's actions, not necessarily an earnings report. And that does make intuitive sense. If a door rips off a Boeing airplane, are you going to buy or sell your shares? If you decided to sell, you're in good company because that incident sent Boeing's price into a free fall, losing almost half its value in less than a year. Now, did anything change about the financials in that moment? No. What changed was everybody's perception of Boeing going forward. You probably could have guessed that, right? And that's what Dow thought. Dow thinks the market is predictable because people are predictable. Charles Dow went on to create the Wall Street Journal as a way to communicate his analysis and principles of technical analysis to the masses. In many ways, Dow is the one who pioneered the way for you and me to make money trading today. Here it is on a bumper sticker. Benjamin Graham and fundamental analysis are all about calculators, while Charles Dow and technical analysis are all about pencils. We call that charting. As active traders looking to create a stream of cash flow from the stock market, we primarily rely on technical analysis. Your job is to now build the skills to mark up your chart and predict the direction of a stock. Now, with some practice, you should be able to pick the right direction at least 70% of the time. Now, that's not to say fundamental analysis isn't valuable. It's just not our primary tool. If you want to do a deeper dive into technical analysis, there's a link in the description for a free PDF that explains exactly how I trade using the ultimate trading formula. And if you enjoyed this video and want to help us continue making content that helps you make money trading, be sure to like and subscribe to get our newest and best training.